What's going on, investors? Listen up, because the news coming out of the Federal Reserve on December 10th is super important for your money. The big question, will the Fed cut interest rates by 25 points? The current consensus is overwhelmingly yes. We've seen a huge swing in predictions, and now major economists, financial markets, and even poly-market bettors are pricing in a 25 basis point cut with a 80 to 85% certainty. That high probability means the market is ready to move. But before we dive into where your money goes next, let's look at the historical context of what happens when central authorities ease up on money. One prominent historical figure who warned against the concentration of financial power was Thomas Jefferson. He once famously stated, "I sincerely believe that banking establishments are more dangerous than standing armies." While he was talking about early central banks, his point about the power of financial control over the economy is still relevant today, especially as the Fed's decision dictates the flow of trillions of dollars into global assets like crypto and tech. So let's talk about crypto. A rate cut, especially in the Fed chair Jerome Powell, hints that more cuts are coming next year, is generally mega bullish for Bitcoin and altcoins. Why? It's about liquidity and risk. When safe investments like government bonds pay less, people pull money out and chase assets with higher growth potential. That's Bitcoin and the volatile crypto market. Lower rates also tend to slightly weaken the US dollar, which strengthens Bitcoin's appeal as a global store of value. Historically, crypto performance has often moved inversely to rising rates, meaning falling rates are a major boost. Now, let's look at your tech and AI stocks. Historically, the technology sector performs very well after the beginning of a Fed rate cut cycle, and we are seeing that pattern already. Stocks like Nvidia and Alphabet are already leading the current rally in anticipation of the December decision. The two drivers are simple: cheaper borrowing. Tech companies who rely on massive capital for R&D and scaling AI infrastructure get to borrow money at lower rates. That translates directly to more investment and faster growth. Higher valuations. Tech stocks are valued on their future profits. When interest rates drop, those future profits are worth more money today. It's pure financial physics fueling the AI engine. So the consensus is clear. The cut is coming. This high probability decision is a monumental moment for capital flows, pushing money out of safety and into riskier, high growth assets like crypto and AI stocks.